US stocks inched higher across the week, while the US dollar is set to end the week lower after some soft data points such as ADP payrolls and core PCE that was a touch weaker than forecast at 2.8%. These supported expectations of a Fed rate cut next week. To talk more about what we should be watching, I am joined by Head of Global Content, John Kicklighter. Thank you for joining us, John.
Thanks for having me.
So, John, after a strong rebound at the end of November, stocks are back to a crawl higher. It's not risk off, but it's certainly not a strong risk on. What are the general market conditions we should expect to deal with next week?
So we're into the month of December, and I think the markets are very happy to be back in a position where things have stabilized. The threat of a systemic risk off seemed to have significantly dropped, and that has really shifted the dynamic of how liquidity is going to influence the markets, in as much as thinner liquidity into what we often consider the Santa Claus rally, the year-end holiday stability, but also tends to have a bullish bias to it. If you look at the historical averages, that's going to probably shift our sense of complacency. So there will be a bias towards risk on, and as everything is calm and quiet and collected, I think it's going to add or reinforce that risk on perspective, not with any significant momentum, not unless there was something very systemic that would offer a pursuit of adding to already very expensive markets. But it's going to be a much more difficult scenario to tip us into a reversal, to really get the bears back into action, to cast off their holiday jumpers and go back into the markets to sell. And that's going to probably be what really defines the circumstances, not just for this coming week, but all the way into the end of the year, into the beginning of 2026. So I think these market conditions have a bullish bias, but also a bias towards quiet or more reserved activity. But that should send us to look to more specific assets that are going to be responsive to key event risks. The themes that we're looking at don't seem to be very productive. The ones that we've seen take the top shelf in 2025. So it's going to be very specific assets that go into something like a key event risk, like the FOMC rate decision, or it's going to be those that are most sensitive to the risk on, risk off movements, which should put us into interest for something like the S&P 500, just as an underlying sentiment drive, also the VIX Volatility Index, to see how that liquidity and activity dynamic is playing out. Obviously, the dollar is going to be very interesting over the coming week because of the FOMC rate decision in the middle of the week. And if you're looking for a particular dollar pair, I think dollar yen is particularly interesting, even though it's been more consolidating. Its fundamentals are also plagued with a little bit of a gray swan, not really a black swan, a gray swan theme with the uncertainties in Japanese financial markets. I'll also watch things like silver and gold on the more safe haven side, but there's a comparative volatility between the two, and at the very end, extreme end of the risk spectrum, you have something like Bitcoin. I think that would be interesting to watch as it's still coming up from a depressed or strong sell-off.
And I guess looking ahead to next week, central banks are a key focus, but what are the most potent themes that you'll be watching?
So I think even though we will be watching monetary policy is going to be probably the top most obvious theme that we have on tap. And we will see things like growth and business confidence as themes as well. I really do think that the top dynamic, and it's not really a traditional fundamental theme, but it is going to be more influential than anything else, is liquidity. Because there's going to be that draw on investors to really back out of the markets because it's looking like it's going to be a nice slide into the end of the year. So for a tangible fundamental theme, though, it will be monetary policy. Obviously, the FOMC rate decision is the top focus because it is a very controversial expectation of a rate cut and how much more cuts there's going to be into next year. Of course, we also have to look at next year and the change of the Fed guard, where we have Powell is going to retire in May, unless he's forced out earlier. What that means, the dynamics of whether they're going to keep with those expectations of just a couple couple rate cuts into 2026, which is what was previously expected. So there's a lot going on there, and that's definitely where a lot of the expectations will be set, not just for U.S. assets. It will carry over into monetary policy expectations for the globe. But you also have the RBA, the Hong Kong Central Bank, the Swiss National Bank, and Turkey is expected to cut rates significantly. It often changes monetary policy substantially, 200 basis points or 100 basis points at each of the moves that it's actually moving. And then the week after, we're also going to have the Bank of Japan and the Bank of England. So it's going to be more of a 2-week dynamic, and expectations will carry forward.
So I feel like we've briefly touched here on event risk, but what is the top event risk next week, which could spur these themes?
Sure, I'll take it chronologically. So I think the first half of the week is just going to be dedicated to waiting for the FOMC. And you're probably going to see the markets react in that way. They're going to really control the market volatility. You might see an extension of these very quiet markets that we had this past week, even though we've seen the restoration of liquidity after the Thanksgiving holiday period in the United States. It's just been quiet. Very narrow ranges, very small ATRs or historical ranges as a percentage of price action. But nevertheless, take in the event risk that we have. Monday, we have Chinese trade, which is going to be very important. Maybe even take note of the New York Fed's inflation expectations figure, because we're really struggling to find more recent inflation figures. The PCE deflator that we got this past Friday was for September because of the delay of the government shutdown. So we have to really scrounge and look for the data that's going to contribute into current monetary policy decisions. Tuesday, we have the RBA, maybe the ADP weekly payrolls, and there's also the Red Book weekly retail sales, and maybe the JOLTS, although that's not confirmed. That's going to be additional data into the FOMC rate decision. And then, of course, on Wednesday, we have the FOMC. There's also going to be the Bank of Canada and the Brazilian Central Bank, but it's really going to be the focus on the FOMC. That's one with a lot of moving parts. So it's going to be important to monitor exactly the components, because the rate expectations for a cut at this meeting are quite high. And I think my expectations are probably even slightly higher than what the markets are forecasting. But it's not just what happens at this particular meeting. A 25 basis point cut is fully priced in. If it's realized, that's not really market moving. So if you're expecting the equity markets to continue to rally after that, or the dollar to pull back after that, it's unlikely to happen because that has been expected. What's really going to play into whether there's follow through or not is the expectations that move forward. And we're going to get updates on forecasts from the Summary of Economic Projections. This is one of the quarterly events for the outlook of growth, inflation, employment, but most importantly, interest rates. And the way that they are priced at the September meeting, they really only priced in 2 rate cuts in 2026. And the markets seem to be expecting more than that, especially because the starting point of those rate cuts was higher up. So we're going to have to see some adjustments on that front. This is going to be a really comprehensive. I think that of all the elements, including Jerome Powell's press conference of this rate decision, it's really going to be the Summary of Economic Projections that comes out exactly the same time that the rate decision occurs. So that's where I expect most of the market movement to occur. Thursday, we get into Japanese business sentiment, the Hong Kong and Swiss national rate decisions, as well as the Turkish central bank rate decision, maybe some PPI, but if it comes, it's coming after the FOMC. It's not really going to have a lot of influence, especially as a delayed month. And then Friday, it's going to be relatively quiet. I know we have the UK GDP figures and trade figures, but I don't think that's going to be particularly market moving outside of the cable unless it's really surprising. And then you have to remember, into next week, we have some really high-level event risk. It's going to be non-farm payrolls, CPI, the BOJ, as I said. And for those that watch liquidity trends, we're also going to have the quad witching hour, which is multiple assets derivatives going expiry, which can have a significant jolt to volatility.
Well, thank you very much for your insights once again, John. Great to catch up.
Thank you.
For more videos like this, please do like and subscribe.